Go ahead.
Great.
There we go.
Mm.
Okay, so today we're gonna talk about one of the products that we all kind of grown to love and we want to do more with, which is gap funding. Okay, a lot of times that we get customers and clients that's looking to fill in the gaps of any type of projects that they may have going on, such as real estate. They may have a deal going on where they don't have all of the capital to finish out the project. They may have 85% of the money and they need 15% to close it out. Or they may have some type of investment opportunity on the table and they're short cash. Okay, some companies may need some operating capital and they need to get creative and get gap funding. Okay, so gap funding means exactly what it's spelled out to say, which is gap. Okay, it is there to simply fill the gap. I'm going to go ahead and share my screen here. I'm going to share my screen and we're going to go over exactly what gap funding is and how you can utilize it. Okay? You guys can hear me okay?
Hear you good.
Yes.
All right.
Loud and clear.
All right. Thank you. Thank you. Okay. So you guys can see my screen okay, correct?
Yes, sir.
All right. Okay, hold on. Second. Let's see, why am I having issues, guys? Okay, I'm just gonna do it like this. I don't know why I'm having issues here. Not sure why I'm having issues. There we go. All right. Sorry, thank you for your patience. Okay, so another word for gap funding, you all, is innovative funding, okay? Or innovative funding strategies. These are ways that we use in the commercial investment world to fill the gap. And so there's a number of ways that we go about doing that. So what does it mean when we talk about innovative financing? Innovative financing simply just means that refers to a range of non-traditional mechanisms to raise funds, so raise additional capital. So what I mean by that is simply that once you're in you're in a project and you're short funds, you have to think on how you can bridge that gap if you don't have the liquidity. And a lot of times, this whole term from gap funding came from the commercial world and a lot of bigger projects when they were building maybe hotels, hospitals, things of that nature, big projects where they didn't have all of the capital to finish out the development. So what they would use is gap funding, which would be mezzanine funding, equity partners, private investors, bank money, things of that nature. So the same concept is what we're using here on a smaller scale, which is to do capital stacking in the same way that the banks and the commercial big guys do it, okay? So innovative financing refers to a range of non-traditional mechanisms to raise additional funds. So the common financial solutions and sources used in developing economies can be classified into 4 different categories. Now that's family and friends. Some of us have family and friends that you can call on to borrow money from, okay? Some of us can have, we've got partners and equity partners, people that have liquidity that can come in as an equity provider. Some of us just do what we normally do, which is get debt. Now, that's what most people do. They obtain debt to fill in these gaps. And that's going to the lenders, going to the banks, things of that nature. Okay. And then there's institutional investors. Your accredited investors, people that will raise capital with you to fill those gaps. Now, in our world, how do we create our source of funding, right? So traditionally, it would be by way of what we call bootstrapping. And that's just you utilizing all of your own resources, your savings, RAs, mutual funds, you know, your friends, family. That's just bootstrapping. So most of us, especially that's in business, that's been in business for a while, we've had to start. I know I started off like that years and years and years ago, using family and friends to help to fund my very first business. Okay. The second way is to get loans. Okay. To leverage loans. And this is what they're doing even right now, leveraging loans. And with gap funding, that's all it is. It's different loans from multiple banks, amortized, which means there's a close-end date. It's a beginning and an end date. And you can also use revolving for gap funding. So there's a plethora of different programs that would be considered as gap funding. Anything that fills that gap to get you the liquidity that you need to make the project work, whether it's an amortized loan, whether it's a revolving line of credit, whether it's an equity partner, anything that will fill that gap. Okay, so with the loans, this is what we specialize in. We have different loans and lenders that we have relationships with that we would utilize to do what's called capital stacking. You have credit cards. You know, I always talk about the story about Spike Lee, the movie producer, and how he produced one of his movies solely based off of credit cards. He didn't have the liquidity, he didn't have the investors, and what he did was he got a bunch of credit cards and he filmed and financed his first movie. So a lot of people will finance their projects with credit cards. A lot of people will finance their projects with crowdfunding, okay? Bank loan. What about angel investors? Venture capital, okay? A lot of different options. So which creative solution do we tend to use here? Okay, which is what this call is about, gap funding. Okay, now the term that this term refers to a type of loan or line of credit. Once again, that would cover the difference between the amount of the existing loan and the total amount that's needed to complete the transaction. All right, so it's just normally used when borrowers need more cash. Now, what is a term? A term is a one-time upfront payment that you receive from a bank, credit union, or an online lender. So this is a term loan. The lender provides the funds and you repay the loan with interest over months, over years. So there's a specified term that's set. So with gap funding, typically, we go with the term loans first, okay? So these term loans is 3, 5, and 7 year terms. Now, what do these terms look like? Well, they look like, you know, maybe a no prepayment penalty, $50,000, $100,000 loan. It looks like a 3, 5, or 7 year term, some of them 10-year terms. Okay, it looks like from an interest rate standpoint, it could be anywhere from, you know, 9.5 all the way up to 15, 16%, depending on the credit file. Okay, this is what the picture looks like. Okay, so what we would do is we would do what's called a pre-qualification call. And with that pre-qualification call, basically we would just pre-qualify the customer to make sure that this customer is able to fit the criteria. Well, what's the criteria? We're going to get into that in a few minutes. Okay, So now unlike the term loan, which is fixed payments, there's also, as part of the gap funding portfolio or gap funding solution, you can have a revolving loan, okay? And a revolving loan has no established term. That means that you can use that money over and over and over and over again. You use it, you pay it back, you use it again. Money is withdrawn by the company, reducing the amount available to the borrower, okay? So once it's paid back and you replenish that credit line, then you're able to utilize that the funding all over again. And so that's also part of the gap funding solution. Now, revolving loans offer customers a line of credit that can be tapped in for various reasons, okay? So various reasons. What kind of reasons would a person want a revolving line? Well, a lot of investors like revolving lines because they do rehabbing. They would like to fix up a property. Once they're done fixing it up, they can go back to their line of credit, reuse that money again, because in the fix and flip world, you've got to have so much money established for the first draw of your flip. So a lot of times investors like the line of credit for that very reason. They also like the flexibility, okay? That's the main thing. Why would someone want a line of credit? Flexibility. Revolving credit allows individuals and businesses to borrow exactly what they need and pay it back over time or just at the end of the billing cycle. Things like credit cards, personal lines of credit, right? HELOCs, those are home equity lines of credit. Those are flexible with little or few restrictions. That's another reason why borrowers, especially investors, like revolving credit, because there's no restrictions. You can utilize it however you want to use it. You can use it for whatever you want to use it on. Okay. So now, what does a customer need to provide to get that line of credit? Lenders, of course, is going to evaluate the credit worthiness. So you can't come. I'm getting a lot of requests with people saying, "Hey, I want a line of credit, and but my credit score is a 530, and I've been in business for 2 months, but I really need a line of credit because this is going to help my business." Well, that's not going to work. The lenders are going to evaluate your credit worthiness. Think about this. A line of credit is risky, right? So it's risky to get someone a line of credit and not, minimize that risk somehow. And the way that the lenders minimize that risk is by using matrix and metrics to evaluate your credit, such as credit score, such as how long you've had your credit file and trade lines on your credit, how long you've had business relationship with others, how did you do with them? Okay, the main thing is with your credit utilization. When you're trying to get gap funding or you're trying to get lines of credit, your credit utilization on your file has always been a deal killer, and which is what would kill deals all the time because your credit utilization is high. What lenders would like to look at is your credit utilization being at least 20% and below. And then there's a DTI, a debt to income ratio. One of the things that you have to really look at when you're looking at your clients or your sales or however, when you and trying to get gap funding, you need to know before you send it over to us is that, Mr. Customer, what's your credit utilization like? Is it under 20%? What about the debt to income ratio? Do you happen to know what your debt to income ratio is? Okay, we need that debt to income ratio to be somewhere around 35% and under. I'm not saying that we cannot get it done with a higher debt to income ratio, but it begins to start limiting lenders that would want to play ball with your client. Okay, so lenders going to evaluate your credit worthiness using these metrics, including your credit score, your loan repayment history, any business risk that you may have, looking at your business credit. Of course, they're going to look at your income, okay? And these are the things that's going to influence the size of that credit loan. That's another thing. So some of you are bringing clients and they want $200,000 credit line of credit, but yet their income is, $100,000. Doesn't make sense. Okay? So, you wanna keep that in mind, that the income is what's going to determine, and the credit risk is what's gonna determine how big of a line of credit you wanna get, okay? So, the minimum credit score is a 680. Minimum credit score is a 680, okay? These are the things that you want to look for when you evaluate your client, and you want to know if I can get this client gap funding or not. You want to use this formula right here. I'm going to add to this as well, but you want to use this formula to kind of pre-qualify before you even go further. And asking your questions, you want to ask these questions. Do you have more than 6 inquiries in your credit file within the last 6 months? What about 3 active trade lines? You want to ask your customer, do they have at least 3 active trade lines that's theirs, not authorized users, but primary accounts that's reporting to their credit? Things like a credit card, a mortgage, a car, things like that. And they would like to see those credit card limits to be over $2,500. Okay, when you're asking for hundreds of thousands of dollars, you don't want to bring a customer who has really credit limits, brand new, of $500 cards, things like that. Because remember, what the underwriters are looking for is the ability to repay. They're looking for the ability to repay, and they're basing it off of your payment history. So other things, they want to know that you don't have any new lines of credit established within the last 6 months. Okay? Any new lines of credit or revolving accounts within the last 6 months. Why is that? Why don't the underwriters want you to have any new lines of credit within the last 6 months? Well, because if you have all of this available credit, you can utilize those lines of credit. And remember, they're trying to base a decision off of your capability to pay. But if you have access to these other brand new lines of credit, well, now they have to take into consideration that you have to now pay for that line. And so they're going to calculate what if you max that credit card or that line of credit out, the one prior to them giving you a line. That's going to start affecting their DTI. Okay, so affecting your customer's DTI. So then underwriters don't want to see that. So for the last 6 months, they say for the last 6 months, it shows the underwriter a rhythm of how you pay and how you keep your balances. Okay, so that's something for you to look at. Also, you want to know that your client has been in business for at least 2 years. For 2 years, okay? So for business customers, this is as it relates to the gap funding. They need to be in business for at least 2 years, and they're going to check the business taxes, which means they're going to do an 8821 and check the check exactly what you filed, and they want to see what your net is. For business customers, they're going to base the determination of your credit line based on your net and not your gross. So for business clients, if they're grossing, just for grins and giggles, $100,000, but yet they're showing that they only made, 10,000, they're going to base it off of the 10,000. Okay, so this is why it's easier times to get W-2 employees approved faster. So if you have a client in their W-2, tell them to use all the income they can. We need to know what all the income is. Okay, tell us where all the income is, whether it's from the job, business, investments. We need to know that because we want that DTI to be as low as possible when we go in and try to get you funded. We want to make sure, as I stated, no more than 20% of your available credit is used. Any bankruptcies need to have been discharged 2 years or more. Okay, 2 years or more. Now, as it relates to this statement right here, the highest line of credit is per lender is $30,000 to $50,000. We're gonna exnate that out right now, because that particular, that particular program for the no income, no asset is not working the way that we need it to work. So please do not promote no income and no asset at this point. Just promote gap funding. That program is still working well. And you can still do lines of credit, but the no income, no asset program, we are no longer promoting that. So that particular statement, the highest stated line of credit amount is that's null and void now, it's irrelevant now. So now, we will use the capital stacking method, as I stated earlier, which is a method that's used to get you the desired number that you need without getting the one lump sum line of credit. Now, most people just want one lump sum line of credit, but most people can't qualify for a one lump sum line of credit. So they have to do it by way of gap funding. Okay. So here's an example. A customer is looking for $100,000 in a no income, no asset loan. We're gonna just say $100,000 a gap funding. Okay, you might get $50,000 loan from one lender, $50,000 loan from another lender. This is how it works. So it's gonna be multiple loans from multiple lenders to make up that number. Okay, so now you need, as I stated, if you need to have a one lump sum line of credit, you're going to need to provide as much documentation as possible to prove that you have the ability to sustain a big line of credit, mainly your financials. So 680 FICO, lower utilization, no recent lates or collection. That's another thing within 6 months that can definitely kill your file. So if someone had at least one late within 4 months ago, that could be a deal killer. Okay, it could be a deal killer. Less than 4 inquiries in the last 6 months. I know the other one said 6, but less than 4 is really kind of where you want to play at. Documentation is a bank statement. You want to have at least 3 months on your bank statements. You need to show your corporate entity, which is the LLC or your Inc. Okay, 1 or 2 years in tax returns. So 1 or 2 years in tax returns. You got to have 1 to 2 years of tax returns. Okay, collateral has to be over 100K. Property, AR, equipment, things of that nature. ARs, accounts receivable. Okay, equipment, things of that nature. A 4506T and an 8821, either one will be conducted. That's to check your taxes. Now, this is how we get paid. There's a 20% charge on the back end to the clients. It's called a success fee. Basically, what that means is that in order for us to go shopping to get you funded, okay, from multiple lenders, that we're going to have to charge a success fee on the back. That's for our time, and that's to and that's for our knowledge of where to go and how to get you the funding. Okay, so it'll be 20% on the back end, 15% covers underwriting, processing, and broker fees. 5% of that is going to go back out to the field. It's going to cover referral partners and Sequoia back office. 4% goes to you. All right, 4% goes to you. 4% of that 5% goes to you as a rep. Okay, so for every $100,000 that we get your client approved, you're making $4,000 on every 100,000. So you do the math. Okay, and customers love this program because they can actually get approved for it. A lot of people apply for it but can't get approved because of 2 major issues. Mainly, it's their debt to income ratio. Mainly, it's debt to income ratio issues. That's the #1 main issue, which is why it's important that you disclose and get your customer to disclose all of its income. Because this is a timing game. You can't really, when you're talking about capital stacking, you have to do this there's a timing to it. You cannot just go and apply and get this funding from here and get this, because they're not gonna like that, okay? So in order to get this done, there's a time that we have to do it with our relationships with our lenders that we know this is gonna get us the funding that you need. Okay, so you want to utilize gap funding and in this scenario with your real estate investors that's trying to close on deals quickly and they don't have all the capital that they need. This is a good place for them to hang out at, especially if they qualify for the funding. Okay. There was something else that I was going to add to that equation. But it'll come to me in a minute. I'm having a senior moment. What questions do you have? Yes, what question you have? Talk to me. Check your mics off. Because I know a lot of you have questions because I'm seeing your scenarios come through. And I know you have questions about how your customer is being processed, how they're being pre-qualified. And I want you to be able to pre-qualify these customers a little bit better before we even get those files. Okay. What questions do you have for me?
Mo, I've got a question, man.
Sure.
I know there's a lot of things that go into the consideration, but so typically, what's a good rule of thumb to say somebody's looking for $100,000 in gap funding? What is the minimum monthly or yearly income that they should have to support that?
So we've been looking at to get 100,000. We've been looking at somewhere between $150,000 as a good marker. Okay, but even if it was more like 120, remember we're capital stacking, so that number is also going to be based on the other debts. So when you're calculating up the DTI is where this really comes to play. That you've got to take the monthly debts and divide it by the monthly income, and that's how you'll know what that customer's DTI is.
Right. So even if they're at like a 20%, DTI or something like that, at an acceptable level, there's still the factor of how much money per month do they make. So they would probably need at least $10,000 a month in income. Is that fair to say?
$10,000 a month income is about fair to say. Correct. Yes.
Okay.
That is correct.
Thank you.
Yes, that's fine, Dan. Thank you. Dave. Any other questions? Any other questions? I kind of went through this, this a little quickly.
Hey, I got a question.
What's up,
Real
Damon?
simple question. Most of the pre-qualification that you're going through,
Yes.
most of the financial vehicles that we have, quite a few of those pre-qualifications are basically the same, it seems.
Yeah.
680, W-2s, et cetera, et cetera.
Yes. That keep in mind, I would definitely use this matrix as a rule of thumb. So
Right.
Now, are there some programs where the credit score can be a little bit lower that we have? Yes, we could. However, if we keep it around the same base, the 680 base, even if it came down, it was dropped down maybe a little, maybe 670 or something, we're still in that ballpark, okay? And we might be able to make it, we still might be able to make it work. But if we let our customers know, we set the standard that this is what it is across the board, universal. This is a good measure and a good metric to use to qualify anything. Using that 680 metric, you can't have more than 6 inquiries, no new debt in the last 6 months, things of that nature. So use that as a good rule of thumb for everything, especially when it comes to unsecured.
Right. Right.
Secured money's a little different,
Okay.
okay?
Yes, sir.
All right, come on, y'all, wake up, wake up, wake up. I know y'all got some questions. And everybody talk at one time. All right, so no questions. So, all right, so if there's no questions, we're gonna end this training a little bit early then. Okay, so if there's no questions, we're gonna end a little bit early. So just remember that with the gap funding, that you're gonna send out the scenario out of your back office to your client. Once you get that scenario out, it'll come back to us. And we, at that point, and hopefully you will give a call to your customer and, kind of pre-qualify them, ask them some pre-qualifying questions before they do the scenario. Okay, that way we're not wasting too much time. You kind of know what to look for. You kind of got to gauge, and then we're going to talk to them as well. Okay.
Real quick, Mo, good job,
sir.
by the way.
Thank you.
As far as gap funding, what is the ideal threshold you want to see on a W-2 income?
So for the W-2, same thing. So that number, maybe about 120, y'all saying is a good number. And let me tell you, the W-2 incomes are a lot easier to get done than 1099s. A lot
Right,
easier to get
so
there, a
you're
lot
looking at about a roughly 10, if they want 100 grand, they need to be cash flowing 10,000 per month,
Yeah, somewhere in there.
120, yeah.
Remember, we're still, and just keep in mind, we're doing capital stacking, so.
Right.
Answer, to the same question that David, actually asked, and the same question is that DTI is going to determine how much we get, because you could be making $80,000 a year.
True.
Okay? You could be making $80,000 a year, and your debts is a lot lower, and you can still qualify for that 100,000 to get that 100,000. You can be
Right.
making 120,000 a year, but your debts is a lot higher, and they won't give you anything but 30,000. So that DTI is the key. So calculate the monthly.
Monthly income. Yeah,
Say that again.
you're saying the monthly income and.
Right. Yes. The monthly
Subtract
income divided by the monthly debt.
Debts, yeah,
The debt payment. And that's going to give you your DTI.
got it.
Okay?
I got another question.
Go ahead, shoot, brother.
You remember that flow chart last week?
Yes.
That flow chart pertains to most of the funding, or is it just specific for gap?
So gap, anything unsecured.
Okay.
Anything unsecured, gap, and what I mean by gap, lines of credit, amortized loans, that just simply means that there's a loan that has a start and an end date, and there's payments, there's the same amount of payments every month until you get to the end date. That's called amortization. So amortized loans and lines of credit both are considered forms of gap funding. So anything unsecured funding. So anything that's unsecured, you want to use that matrix of that 680 and better credit score. They no more than 6 inquiries, no new debt in 6 months, the 20% credit utilization, under 34%, 35%, I'm sorry, 35% DTI, things of that nature. You use that as a standard, then you don't have to try to figure it out.
Right. And forget about Nina. Nina is over and done with.
Forget about
We're not
Nina,
presenting that.
Yeah, do not present Nina anymore.
Okay. Gotcha.
Okay.
Yes, sir.
Any other questions?
I had one, Mo. Andre, Boss Hats,
Hey,
Texas.
Andre,
Dallas. when do you foresee the EV charging stations coming online?
That's an Allen question, man. I will be in Chicago with him, next week. I believe next week, and for that reason, so, we'll be rolling that out soon, but that's an Allen question. That's more of his baby than anything,
Okay,
but it's on the horizon. It's really, really soon.
that'll work. That'll work. Thank you, sir.
Okay, you're welcome. Any other questions? No other questions? Okay. Okay, well, listen, I will see you all on this week. Remember Thursday's training, Thursday's the sales training. You guys can plug into our sales training. This week, we're gonna be training on fix and flip and showing you how to sell fix and flip. And then we have our Friday training on this week, and we're gonna be talking about the essence of time and time management, okay? And just showing you how to maximize your time better in order to be successful in this business. So without anything further being said, I will see you all on.
Wait, Mo, I got one more question. I apologize. I just remembered. If I want to bring one of my friends on to check out one of the Zooms, what night should I tell my friend to log in? What's a good night?
Wednesdays is good, Fridays is good.
Okay.
Thursdays are set aside really for us to train on sales, so that's just for kind of us, okay?
Okay.
But, and then Mondays are the opportunity call. So the opportunity call to talk about the business and what and how they can get on board with Sequoia, things of that nature. That's on Monday.
Okay.
So they always at the same time, 8 o'clock Eastern Standard Time, 7 o'clock Central. Always the same time.
Sure. No problem. Thank you.
Okay, you're welcome. Any other questions? Anything else? Did I miss anything? Is there anything that you don't understand about gap funding or any questions, any projects that you have? Okay. All right. With that being said, you guys have a good evening, and I'll see you all on tomorrow and see you on Friday.
Thank you, Mo. Have a good one.
Right.
I appreciate it, Mo.
Thank you, Mo. Good night.